All right, what is up, people? I am here today to present to y'all today War in Stocks from Pulp Fiction, which is pretty exciting. I want to get into this video today. Kind of want to get into the details about the history of how the stock market and crypto and all the markets have kind of performed during times of uncertainty during war times, and how it has reacted on the short term, the long term, and yeah, let's get into it. So right now I got a chart that I made of 3 different time periods, relatively not too long ago, a couple years ago. The first one is the war between Israel and Gaza, when that started, particularly in October 2023. This chart pretty much shows what happened the subsequent 2 days after these attacks happened. So after the start between Israel and Gaza happened in October 2023, you can see the first yellow column. That's a percentage of how much Bitcoin went down. The blue is how much the S&P 500 went up by. And I kind of did that just because Bitcoin kind of represents pretty much the majority of the crypto market cap and the crypto market in general, mostly because it is over 50% of the market. And I did the S&P 500 because, well, that's usually the generally used index to see how well the overall market is doing. I didn't do that for Bitcoin just because there really isn't one yet, as of yet, for it. There's some informal ones, but I just did Bitcoin because it's the easiest. But anywho, Bitcoin actually, as you can see, went down negative 1.8% right after the attacks happened between Israel and Gaza in early October 2023, down 1.8%. The stock market actually, on the days that it was opened, what I did with the data for the S&P 500, if it happened on a Friday or something, or Saturday or Sunday, I did the 2 days that were open. So the 2 days the market was open, it was up 1.6%. So it actually went up. Surprisingly, most people would think that if this, these kind of things happen, especially a very hostile and scary area, because of oil and whatnot, the market would go down. But it actually went up during that time. So that's pretty interesting. And down here too, let me get my little pointer. Actually, I don't want laser pointer. I want pen. Yeah. So actually, you can see down here, I have Bitcoin showing Saturday and Monday, and I have the S&P for Friday and Monday. It's a little off, but it's the closest I can get to the events. But it was the best I can really do. In the next slide, you'll see a little bit better representation over a longer term period. But anyhow, so in the next column or columns or whatever you want to call it, the Red Sea strikes that happened actually not too many months after, in January 2024. The 2 days following that, Bitcoin actually got hit very heavily during these times. It actually went down negative 5.8%, which is massive, for stocks. I mean, it is massive, but comparatively to other times, and for Bitcoin's history, 5% is not huge, but it is enough, enough to still do some damage. But anywho, the S&P 500 during the 2 subsequent days pretty much relatively did nothing. It's down negative 0.4%. Cumulatively over that time. But anyhow, so the next one, the Iran strike, that's pertaining to the strikes that happened halfway through June of 2025. So as you can see, for Bitcoin, actually got hit again. Almost all three of these, you can see that Bitcoin got hit. It got knocked down on all three occasions for the couple subsequent days, going down negative 3.8%, and the market going down negative 1.5%. So pretty much, for Bitcoin, you could see that almost every time any of these things happen, the crypto market just gets hit. And pretty much any of these times with the S&P 500, it relatively doesn't at all, really. At least these three occasions, not really much. Not really much happens for the most part. It's kind of negligible for the most part. And if something does happen, and if my day is off a little bit, just because of the opening and closing of days, I think it might be. But if it is, it's still, the day that it would catch, it's still not showing up in the data. So I mean, this next slide, this kind of goes into, let me pull it up. This next slide, it kind of goes into the 90 days following those events. So this is a little bit more, in my opinion, kind of showing what, the 90 days following after the event happens, and, how people feel after it. So what happens in the 3 months following these attacks and wars and strikes and whatnot. So as you could tell, for Bitcoin, for the Israel and Gaza attacks in October of 2023, Bitcoin did amazing. It went up almost 35%. And if we include the previous slide, as to how much it went down by, if we started from that low point, it's probably up over like 35, 36, 37% in those 3 months following it, which amazing. Now, yeah, it did really well. Now, if you look at the S&P 500, it actually went up as well 4.2% in the 3 months following the conflict. So it did pretty well those 90 days after. Now, if we look at the Red Sea strikes in January, not too long after, January 2024, when that occurred, the 90 days after that, both pretty much crypto and the S&P 500 relatively up 8%, pretty much for both, for the most part. So kind of the same, honestly, really, for the most part. And this last one, I really don't think that it really kind of resembles too much of, honestly, too well of how well both markets have performed since then, because the data is too new. I made this slide and I didn't realize that this only happened 2 weeks ago, so we couldn't have 90 days worth of data in 2 weeks. But if you guys want to know, they're both down about 2% since then. So, since Iran struck, they're both kind of down a little bit for both. So they're both a little bit down, but we'll see in the subsequent months how they'll perform. But we'll see. And in part to that, for the next slide, it's going to be kind of going into detail about previous wars in the early 2000s and some other, early 2000s, maybe 2010s, 90s, and let's get into it. So the Gulf War in 1990, the 1 week after that happened, the market actually went up 1.9%, which surprising. It did pretty good. Afghanistan, though, was obviously different, being down negative 11.6%. Now, I got something I want to get more into about that later on as to why I think it went down so much. But that's the data for that. For the Iraq War in 2003, it actually went up. The market subsequently, the week after, did go up 2.3%. So two or three times the market actually has gone up. So 2 to 1. It most of the time it seems like for these three cases it has gone up. Anyhow, so I got more data for the four other wars we're in. So for World War I, World War II, Korean War, and Vietnam War. And so for all four of these, I've gotten the same thing. How has the market changed a week after? And pretty much a week after World War I happened, the market was up 2%, and World War II was up 3.8%. Korean War was down negative 4.5%, and Vietnam was down 1.2%. So overall, if we look at pretty much how the markets get affected the week after, it looks like for the most part 2 to 1, 2 to 1, 4 to 3. So 4 out of 7 times the market will go up. 3 out of 7 times the market will go down. And these are, I'm talking about like the big wars. I'm talking like the big the big ones for the most part. The big conflicts. Historically speaking. So, whoops, did I go too far? Oh, yeah. Anyhow, but yeah, that's segue into the next thing. So, so it looks like, well, it is the Gulf War. The Gulf War. I didn't mention this. This slide pretty much goes over the year after these conflicts happened. So instead of a week, now we're going to 1 year. And 1 year after the Gulf War started, markets went up 17.6%, which is amazing. I mean, historically, the S&P 500 is, averaging like 10% a year. So to go and get 17%, 18% is really good. I know most people today aren't really thinking that's, thinking that's normal because, or used to it at least, just because, the past 10, 15 years, we've been on an insane tear and huge bull run. So, but it is a lot, that's a big, especially after like having, conflict and uncertainty during that time, and having war, it's surprising that it went up the year after, all that's going up, that people are confident to put the money in the market, so. And if you look at Afghanistan, 2001, a year after, it is down, 12%, 12.4%. But the thing though is, if you look back, it's not really too much further down than it was the week after. It really hasn't changed too much. The price really hasn't changed or the amount it's been down at least changed too much since the week after, honestly, being only down 1 more percent. So but that is down a good amount. But I'll show some graphs later on as to why I think there's other macro events that were going on that kind of affected that. And if you look at the Iraq War in 2003, that did really well. I mean, 25%, 26% up in a year after having and during conflict, pretty much for all three of these, honestly, going up in the year following these conflicts. I mean, they're in the war practically with these countries. So it's very surprising that people are putting money in the market during these times, just because you think that people would be so scared to put money in, not knowing where the U.S. would be, years from the start of it. But people I guess, see that, hey, more's, more's going on, and I don't know, maybe businesses are just making more during this time. But anyway, let's go to the next slide. So, yet again, this goes into the year following after these four wars again: World War I, World War II, Korean War, and Vietnam War. So, if I remind ourselves, back to the week following, that's kind of what it looked like the week following. Half and half, pretty much. Honestly, they look like kind of mirror each other, really. But anyhow, yeah, these things have done really well. The year following, World War I up 10%. The year following, World War II being up 15%. The year following, the Korean War up 21%. The year following, the Vietnam War, being down 5%. So if we look at it on average, pretty much the year following, after all these wars happened, 5 out of 7 times we're looking at being up 15 to 20%, or 10 to 20%. But on average, looks like roughly 15%. So, anyhow, but yeah. Anyhow, this next slide I'm going to go into is going to be looking more at the World War I, as to how the market did during that time. So World War I, it really, honestly, there's a lot of choppiness going on during that time. There was a lot going on, a whole lot, a lot of up and down. I mean, pretty much throughout the entire time, it's going up, it's going down, it's going up, it's going down. And I mean, that 10% honestly might be kind of off, just because, as you could tell, I mean, we're down, we're up, we're down, we're up. So I kind of want to bring this chart just to kind of show a little more, detail as to how the market actually did. And I kind of highlighted how the market did 5 years after the start, or the relative start as to when it happened. It probably honestly happened later in the year, and that's probably why I got that 10%, probably not in March. But anyhow, and yeah, so during this entire time, there really was just a lot of choppiness going on for the most part. There really wasn't, well, I wasn't gonna say a whole lot going on, but there obviously is a whole lot going on. I mean, you got the World War I, you got this, the 1918 flu going on, a lot of uncertainty. So the market really didn't move too much during that time. But yeah, this next slide pretty much goes into World War II. I didn't even mention this, but the reason why this is a line chart is so ugly is just because of the fact that I couldn't have the option to get bars, for the chart during this time, just because they went by months. So it really didn't, the candle options weren't really a thing. So just kind of excuse that. But this one looks a lot better, just because it has the bar chart and kind of can show how the market moved during the time. But yeah, so for World War II, during this time, the 5 years subsequent to it, as you could tell, there was a scare and there was a big move up for the most part 5 years after. going up 70% in the 5 years following. And just want to go over too, pretty much all these charts are 5 years after. So 5 years after in World War One, nothing pretty much. 5 years after for World War II, up 70% with a dip in the beginning. And same with this, there's always a dip in the beginning, at least especially these older wars. And yeah, that kind of covers World War II for the most part. Just going down and going back up, and going up quite a bit during that time. But let's see, next slide. So next is the Korean War. Korean War pretty much was straight shot up, pretty much the entire 50s. Looks like from late 40s to late 50s, pretty much that 10-year period, pretty much just a straight line up for the most part. I mean, that just doesn't get any more beautiful than that. I mean, up 120% since the start of the Korean War till 5 years after. I mean, honestly, January probably wasn't the start of, the war and whatnot. I just did the beginning of 1950. I should have got the exact month, but I mean, even if it was a few months later, it's still up a lot. During that time period, it really didn't, affect it too much. I mean, that wouldn't affect the data too much. But for the most part, you can see the only time I went down, honestly, was, this little part right here. But after that, it still shot up crazy. So, and I bet you right here is probably when the war started, I bet. I wish that candle there or something. But anyway, it's negligible in the grand scheme of things. It always seems like when these wars start, they pretty much have that knee-jerk reaction, go down a couple percents, maybe even more if you get really scared. And then they just shoot right back up, because the Fed gets scared, they lower interest rates, or they print more money, or they do something to prop the economy up, just because it's such a, obvious, obvious thing that is seen and, get scared about and get uncertain. But anywho, let's get into the next slide. So this goes over the Vietnam War. The Vietnam War was very interesting. Very long war. It's very interesting because the beginning, as you could tell, is up, down, up, down, up, down, up, which, there's a lot going on there, but it still did really well in the beginning for the most part. It still had its higher highs and, higher lows, and still going up higher and higher. And that's good and all, but pretty much it did nothing for all these years for the most part. It really didn't do anything for the entire 70s, really. Honestly, I don't think the market since mid-65 till into the 70s, it really hasn't done anything. But that's because of other, greater macro reasons, honestly. Just because, there was high interest rates, and there was high inflation to fight it, and Vietnam War was in there in the mix, and then you had the getting up the gold standard, and I think that this flatness is just because people during that time, had all those things, but then on top of that, they had the high interest rates, and so then they're thinking, why the heck do I even invest in the market when I can get, a 15% return on a CD, So, and there's a war going on, so why would I put my market in the war, when there's a war going on, when I can get a guaranteed return, or said guaranteed return, as long as the, U.S. doesn't not pay its money back, or, sorry, doesn't pay their money back, as long as they don't do that. But yeah, pretty much in the beginning, it did pretty well. A lot of turmoil going on too, and there was an oil crisis too. I mean, there was 15 things going on during this time, and but yeah, the first 5 years actually didn't do too bad for the most part. So not too bad, but yeah, let's get into the next slide. So the Gulf War, did have a dip, did get scared, and then it shot right back up. But then it did nothing. Pretty much did nothing for like 4 years. So just kind of really did nothing for the most part, which, is what it is. But then right after, straight up, market went straight up right after that. Now that has nothing to do with any of this, but I think we all know that the dot-com bubble happened, and that's when the market started really going. But that has nothing to do with the Gulf War or anything, so did include that. So, but yeah, let's get into the next slide. What do I have? I don't even know what I have for the next one. Oh, the Afghanistan. Yep. I wanted to go over this. I mentioned this earlier in the video. So the market is down 28% after 1 year after 9/11. Now this is a little different because that 10%, 15% I had is probably like halfway on this bar, and it may affect it or whatever. Regardless, it's down a lot after 9/11 happened. When 9/11 happened and everybody got all scared and all that and freaked out, initially, as you could tell, we got this giant candle right here. Then it rebounded pretty good. Rebounded actually practically right where it was. But I think that it went down so much just because of this greater macro event of the giant dot-com bubble just popping and going straight down, so I think that's what was going on. And I bet you if that wasn't going on, I bet you this thing would have looked like what it was down here, 2003 and so on. I bet you would have went like that, But I mean, not financial advice or anything. I just, it's just a prediction. I don't have a glass ball or anything. I don't know the future, but yeah, I think that's a very important point to distinct. And also another thing too, Afghanistan war was a very long war. I mean, lasting from 2001 all the way to 2021, as you can see here. You can see 2001 all the way to 2021. Pretty much for this entire 20-year span, the market was up 228%. So I don't really think, in my opinion, that war really affected that price in that way. Maybe like initially it shot it down, but overall I just think that it was just the greater macro landscape that was affecting the entire drawdown for the most part. This chart is pretty much just trying to show how the market did during that time. Now, do I think it was the reason why it went down or up or left or right because of it? No, honestly, I don't. Personally, I don't think so. But let's see what's on the next slide. The Iraq War, yes. The Iraq War lasted from 2003 to 2011. This actually is pretty much the flip of wars in Afghanistan. This pretty much happened at the bottom for the most part, and well, I've been picking January just because I don't think I've been doing the correct month for it. Even if I did, it still went up a lot. But the 5 years following, it went up. You can see 67%. Went down a little bit because people got scared, and it went straight up. It's been pretty much the theme. Everybody gets scared and go straight up. Not saying that's going to keep doing that forever, but it's good to know that, and good to understand that, hey, just because it goes down a little bit that week and everybody's panicking, it doesn't mean that it's going to go down another 10% in the following year. Now it might, but I'm just trying to point out a pattern here, because most people, they get scared, they hear war, they get out of the market, they flip out, and then the market goes up 70% the following 5 years. So, and you accrue all that capital gains tax. So, when you sell. So, I mean, is what it is. But let's see what's on the next slide. So yeah, this slide, I mean, this pretty much just goes over that entire time period of the war, which obviously this giant wick down, I mean, was the housing crash, and had nothing to do with the war. It, pretty much had nothing to do with it. So yeah, that's pretty much the end of the video. And if you liked what I got, subscribe and like the video. And thank you guys. See ya. Bye.